Guys, thank you so much for joining us. Really appreciate it. Eric is going to be leading the panel. Super excited about it. And very relevant panel, not just in the US, as we have I think it's up to 43% chance of recession in the next year. So as we start getting closer towards that kind of cliff or slope, we have no idea. But something that's going to be super relevant is that we have a couple of viewing parties in the UK right now, and we're going through Brexit and everything else. I know that they're going to be running into similar issues most likely much sooner than we will. And so very relevant time for a panel like this. Super excited to have you guys on. I'll kick it over to, there's Austin. I'll kick it over to Eric. And Eric, you can start, and then everyone can go through their 1 to 3 minute high level overview of you, your firm, everything else that you do, what you're excited about. And Eric, thanks again.
Cool. All right. Hey guys. I guess to start, my name is Eric Hawke. I'm the vice president over at Amplify, which is a pre-seed stage fund based here in LA. And I guess, to start, I'm going to hand it off to all you guys to start introducing yourselves, tell us a little about yourself, your fund, and then also, just given the topic, Lucas mentioned, there's I guess a 43% chance there's a, possible recession in the next 12 months. So, what's your take? Quick yes or no. Do you think that there's a recession, looming in that timeline, or are we good for the near future? Alex.
Yeah. Can you hear me?
Yeah.
Okay. Yeah. Okay. So hello everyone, and my name is Alex, and I'm the managing director at Plug and Play. So Plug and Play, more about Plug and Play, we recognize as the most active venture capital in the United States with over 250 investments globally every year. So essentially we have built the largest startup ecosystem on the planet, and we have over 15,000 companies in our ecosystem, which these companies raised over $7 billion fund from us and other venture capital firms, and their market cap is over $35 billion so far. And from 1990s, Plug and Play was a house of a lot of successful entrepreneurs like Google co-founders. We had Logitech, Danger. We actually gave the first $100,000 to Lending Club co-founders. We had Voodoo, PayPal, Dropbox, and we had over 95 big exits so far. And our headquarters is based in Silicon Valley and is almost 200,000 square feet campus. 450 companies actively working from this location at any time. And we have over 300 corporate partners in 14 different verticals. That's all. And we expanded to 15 countries and 29 locations like Germany, France, Netherlands, 8 offices in China, Japan, Singapore, Brazil, Mexico, Italy, and so on and so forth.
Cool. And a quick yes or no, what's your take on looming recession?
Oh, so based on the standard economy theory, there are two different theses. One can imagine that the most of this VCs pulling out their money and investments from hedge funds and investment, from venture capital firms. However, the other side, many might think that the government will cut the interest rates, which can affect the capital become much cheaper. For us is we have a long-term roadmap, and with recession we can sit on the capital, and we don't shut down our fund regardless what is the situation, assuming it's not a World War III or something like that crazy. And for sure, we might try to be more cautious on selecting the companies, and we might get some distance from specific verticals or industries that might impact it by the recession. But in general, the investment will continue, and even with better terms on our side.
Cool. Thanks, Alex. Brett, let's go with you next. Brett, you're muted.
There we go. Can you hear me?
Yep.
Perfect. So Brett Munster, principal at Hawke Ventures. We are primarily a Series A, Series B focused fund, headquartered in San Francisco. We have another office in Stockholm, and I'm based full-time in Los Angeles and cover most of Southern California for the fund. Your question towards the economy, it's hard to have a downturn when everyone is predicting a downturn. So I'm going to go contrarian and say, no, we're going to be okay because everyone else is saying we're going to have a downturn here soon.
Cool. Thanks, Brett. John, let's go with you next.
Yep. My name is John Brocious. I'm with Social Starts and Drawdowns Partners. I'm the only teammate in LA, but we're primarily in the Bay Area, New York, in Austin as well. Pre-seed to seed fund, we don't lead typically 100 to 250K investments. Spend time in education and healthcare, direct-to-consumer brands, other consumer tech, vertical SaaS, as you'd expect. Not necessarily generalists. We stay away from insurance, pharma, but do cast a wide net. And then in terms of the question, if we look back even to 2012, folks were saying the economy, was softening, and we've been in a 10-year bull market. I think it's too hard to predict, and I'm not a macro expert in terms of the next 12 months. I would say that in the next 24 to 36, there's a high likelihood that we could be in some sort of stagflationary environment. But too hard to say yes or no in the next 12 because 2 years ago we were saying 2019. Last year we're saying 2020, so a little hard to predict right now.
Cool. All right, thanks, John. And then Matt, we can go with you next.
Hey guys, Matt Hirsch from Fika Ventures. I'm a principal over here. We're a seed stage fund based in LA, about 120 million under management. I was a founding team of JetBlue. We took that from 5 people to 20,000 on IPO. And then after business school was a BD and sales exec, and recently joined Fika. Well, not recently anymore. It was about 2.5 years ago. So the recession, yeah. So, I don't have a lot to add to what John just said. I think economists are probably about as accurate as the weathermen are. And 43% is still less than half. All the indicators would indicate that, the economy is still strong, right? We're in a 10-year bull market, the lowest employment in over 50 years. I think the growth of the GDP in 2018 was the highest it's been since the Great Depression here. So, and inflation's low. So all those sort of factors point to a fairly stable economy. But if you look at the history of the US, it's sort of bound to happen, but it's anybody's guess as to when that will be.
Cool. Thank you, Matt. And Austin, last but not least.
Hey, everyone. Austin Clements. Can you guys see me?
Yep.
Okay. So for the last 4 years, I've been with TenOneTen Ventures. TenOneTen is a seed stage fund. My focus, where I like investing and what I'm actually most interested in, is around small business. So for me, it's technologies that enable the creation of new small businesses, also around tools that support various small businesses, and then bootstrappers who are looking to scale their operations. So made a couple of investments in that area, but TenOneTen is much more broad than that. But that's just sort of my area of specialization. One thing that's really interesting to me on the economic question and just broadly what's happening and whether there'll be a recession or not is I guess indications for really sort of what a recession looks like, and how it impacts the people of the actual country. Like certain things I think that we may be looking at wrong, like inflation as a whole, as an aggregate, in that, in a country where there's sort of a wealth disparity that's growing and sort of a shrinking middle class, to measure inflation, like just practically speaking, it's like this is inflation for whom and for what? Because for one class, things seem to be very in check, and then for the others, things seem to be actually quite inflated, and the cost of living is a lot higher. So on the recession piece, I wouldn't be surprised if we were to go into a recession in the next year or whatnot. And I guess what I spend a lot of time thinking about is building businesses that are prepared for that, where venture traditionally has been about scale, and then let's figure out a business model. I like to think about businesses from the standpoint of like, let's get the unit economics and a few things, foundational things correct so that you could weather both the ups and the downs of the market.
All right, thank you guys. Yeah, so for the rest of the panel, kind of want to spend time mostly looking at two fronts. So one, we're going to ask questions around, what happens to a startup during a recession, how to think about, going into a potential recession and being in a recession if you're a startup, and then the same thing for a venture fund. So, what happens to a venture fund in a recession, and how should a venture fund, if at all, prepare for one, things like that. So I guess to start, and I think Austin, it would be great if you start on this one, because I think you had the most, and everyone gave nuanced answers on whether we may be moving into recession. But I think, Austin, you were probably slightly more in the camp of things might go down sooner. So I'll have you start. But I guess to all of you, would your investment strategy change if you believe there's a recession around the corner, or not, and why?
My strategy won't change because I feel like, good or bad, I'm looking at building businesses with good fundamentals, and that, I guess, fundamentally shapes. I started my career in investment management for private wealth during the run up to 2008, and then the collapse afterward, and talking to people all day and night long about how I lost a third of their net worth will definitely have an impact on how you think about investing and how you think going forward. So I think that's shaped a lot of how I think about preparing or any investment to make sure that it weathers all types of cycles and all types of environments. And I guess that could be viewed as almost the equivalent of value investing versus growth investing in the startup world, but I guess I don't necessarily see it that way. I still think that there's massive opportunities to be had by taking that approach. So to answer your question straightforward, my investment thesis doesn't change regardless of the cycle, and probably for all of us, because it's so long term anyway, it may not change much either.
Cool. Yeah, thanks, Austin. And then, anyone else, feel free to, jump in and add your thoughts. Brett.
Yeah, no, I agree with Austin on, I don't think our strategy changed. I mean, if you look at, every year there's a handful of startups that are built and started that, go on to have, great success, regardless if it's a downturn, an economic boom, bust. Great companies are started in all economic cycles. So, I think you can back a company at, any time during an economic cycle. The other thing is, as Austin alluded to, and he's 100% correct, is, you invest in a company and you're, with that company 6, 8, 10, 12 years, you're going to go through a recession through that time frame and through your fund's life cycle. And so I think part of it is that strategy is kind of built in, or at least should be thought about, right from the beginning anyway. And so, we think about it in terms of consistency. What are we going to do every year? And we're just going to stay consistent on what we do. So our strategy doesn't change. We reserve enough capital to help our companies, hopefully through those down times. But we like to stay consistent.
Cool. Yeah. And I guess I'll just add to that while you're on, Brett. Sway, I've known you guys for a while. It seems like you primarily do A and B. You've done some seed. I imagine you've done some later stage, even beyond B. Do you think about it differently by stage? Or really, your answer stays consistent depending on if it's seed or, down to C and beyond?
Yeah, I think at our core business, A and B, and then even seed, because it's earlier, those, companies last for such a long time that I think you can bucket those and we stay consistent. It's basically the same. We want to do what we do. from time to time, we do kind of, dip into some growth stage stuff, and that might affect if we think we're going to invest in a company that might go public in the next year or two. I think that's when, that analysis starts to play a bigger role. But for the bread and butter of what we do, most of what we do, we try to stay consistent.
Cool. All right, thanks, Matt.
I can comment briefly on it from our perspective. So I kind of agree with these guys that our investment strategy doesn't change, but our comfort levels do. I think for us, we kind of feel like it's the wild, wild west out there right now, largely driven by the bull market. There's more capital than ever flooding the market. There's companies that are getting funded that shouldn't get funded. There's companies that are pre-product and pre-revenue. It's like who are able to secure mid-teen and 20 million caps on their valuations, which means it's a kind of a scary time. So I think if anything, having just closed our second fund, we kind of can't wait for the recession to get here soon enough from an investor perspective. It's going to bring down those valuations. We're going to be able to retain, our ownership targets for less money, and thus there's going to be less risk. I think, personally, my perspective is that less money enforces more discipline on companies. So, a recession isn't always bad. It's a correction, right? And I think it can lead to good outcomes, frankly.
I'd echo Brett's sentiment as well, or excuse me, Matt. Sorry about that. I'd echo his sentiment as well. I don't think our process is going to change. We're still looking for the fundamentals of business, low burn rate. We're looking at pre-product market fit companies at the pre-seed and seed stages. So we're looking for those good fundamentals, not overspending on real estate, right? We look at real estate as a percent of burn, not hiring until, XYZ sales hire until there's the establishment of product market fit, right? So we're looking for the same fundamentals. But it is interesting to see there's fewer seed deals being done with a lot more capital coming in. And so, I think that's an interesting phenomena to consider that, folks are tightening, if you will, being a little bit more selective. And there's a lot of capital out there. So even with the recession, I don't think that, the number of seed deals that'll be done will change significantly. But I do think, as pre-seed and seed investors, we're going to have the hat on of, what's Brett going to do, right? As Series A or Series B investors. And so that could also lead to some slight tightening as well.
Cool. So unless anyone else wants to jump in here, Alex, did you have a thought?
I kind of covered that answer in my introduction.
Cool. All right. So as we're going to move on and spend a little bit of time talking about kind of startups specifically in a recession, what they should be doing. So, to start, I guess, how would you guys describe what happens to a startup, during a recession? So, if you're a founder of a startup listening, what should they expect should change from a funding perspective or a talent perspective, sales perspective, and overall, should they be fearful or not so much?
Well, I'll start with this question. So in general, my advice for early stage startups is to have like 15 months minimum runway and cash in the bank to build their teams and execute on their business model. But if they feel that a recession is coming and they can have more cash in the bank to cover up to 36 months, and this is what I recommend. And I remember then when I was talking to Jeff Stoibel, who was the chairman and CEO of Dun & Bradstreet back in 2014, he told me that the only reason that he survived during recession was that he had enough money in the bank to support his team. And while other companies started to lay off, all the competitions, his competitors started to lay off, and and then filed for bankruptcy. And to him, that was the biggest reason that he could survive and become the youngest CEO and to take the company to IPO. Back, I think it was back in 2007. So I think it goes back to the judgment and the judgment call. And in general, having more cash if there is something possible. I mean, coming and like 30% chance would be something that again I recommend. And what I want to add is that the founders, if recession comes on the financial side, even might consider to apply for loan from the banks, which might be cheaper and easier.
Awesome. Thanks, Alex. I think John, you had something to say, or was John, you're muted.
It just goes back to, I think, the fundamentals on burn. Do you have a plan where you could potentially go from 10, 15, 20K in burn down to 5 or 10, right? And are there tactics to acquire consumers that aren't costing part of your marketing spend, right? So could you potentially lower that to extend runway? So I think that's one tactic. The second tactic, I wasn't an investor during this past recession, so I'm not an expert. Don't take this with a grain of salt. This is more of what we're advising our companies. If you're raising around and it's 15 or 18 months runway and it's not going to dilute you significantly and you can take the capital, it might not be a bad idea to look more towards kind of 18 to 24 months of runway. If you believe that there's going to be some softening in the market. So those would be, I think, kind of the two tactics that we're advising with our portfolio company.
Awesome. How about you, Brett?
Yeah, no, it's good advice. Another thing to consider, one, we always have all of our companies have, basically their growth plan, but then, a plan B in place, right? And understanding what levers you can pull that can extend those runway, whether it's marketing spend, whether it's hiring or potentially even cutting staff. The other thing that we kind of talk about too is, who that customer base is and depending on the industry and depending on, if you're a SaaS company and all your customers are other startups, you're a little bit more at risk versus if you're with, more Fortune 500 companies, you're probably, that customer base and that revenue is probably more stable. So it's also understanding, not just, is there a recession, but, where your revenue is coming from and how likely that could possibly go away.
Awesome. Yeah. And I guess, same thing is like, I would also add, how do you guys think about this, by stage and also, by sector? So you talked a little bit about B2B startups. Does it change for consumer startups?
It does, depending on the sector, right? I mean, if you're Dollar Shave Club, right, and everyone's going to buy razors no matter the recession, right, then you're probably okay. But if you're in a more entertainment or some focus that is likely other spending that could easily be cut out of a consumer's budget, that one might be a little bit more troublesome.
And I guess one thing that we're seeing, and I'm going to leave you on for one more, Brett, at least with a lot of our like Series B and even in some cases Series C companies, is that we have at least a couple that have like prioritized getting to cash flow positive, at least in the near year or so. Is that something you would advise later stage companies to do that do see a path towards profitability, or should they continue to be thinking like a startup and reinvesting and investing growth capital for the purposes of growth?
Yeah, it's a question we have and a discussion we have at the board level all the time is, by getting to, profitability or, cash flow positive, you control your destiny at that point, right? You have all the options. At that point, you can continue to keep growing at that pace, or you could choose to go out and raise a bigger round and, step on the accelerator at that time. So understanding your ability to go do that, I think is definitely a great idea. And we talk, especially at the later stages, B, C, where a lot of them have that path towards, at least being cash flow positive. Doesn't mean they'll necessarily get there because there might be reasons to step on the gas and continue to accelerate growth. But there is at least a plan to get to there. Absolutely.
If I could add, just taking a look at the public markets and how that's played out, like looking at the stock of all the a bunch of high growth companies that have, it seems like it's going to be a stretch for them to get to being cash flow positive. So many of them, just haven't performed well in the market where like, since they've been public. And on the other hand, you look at a company like Zoom that had, pretty good economics and seems to be doing quite well in the public markets. I think that when you look at these larger investors that invest publicly, it does shape later stage investment decisions, which does shape earlier stage investment decisions. And I think that people are starting to pay a little bit more attention to that as well.
Yeah, along the same lines, I mean, we have a whole class of digitally native vertical brands that wasn't even around last recession. So, regardless of a recession, I think Instagram and Facebook ads have increased 40% in terms of cost year over year. That's, I think, why you're hearing this sentiment in terms of thinking about an omni-channel approach. Retail's back a bit. But, double clicking, going back to the point about digitally native vertical brands. I mean, I guess there was Bonobos in kind of 06, 07. It was still figuring out their, online acquisition, but consumer confidence has been high, right? It's kind of ebbed and flowed across the last 8-9 years. I think it's softening a little bit, but what happens to, a lot of those companies that are relying on online acquisition, early on? I think that's definitely a question we're asking ourselves. I think others are, and strategically or tactically, I think that's why you're hearing earlier stage companies thinking about an omni-channel approach. Do they have a channel partnership? Do they have retail relationships where even in a face of recession, hopefully, they have some ways to continue to acquire customers?
Cool. Awesome. Thanks, guys. All right. So I guess to continue, so one more on the advising startup side. So if you're advising someone who is thinking of starting a business today and you felt that, yes, wholeheartedly believed that there was a recession looming in the next 12 months, would you advise that person to start a company now or wait? So I guess another way of phrasing this is, is there any risk of potentially being that person who starts their company at the height of a market just before a crash? Yeah. So whoever wants to.
I have a strong opinion on that. If you're timing the market on starting a company, just don't start the company at all. That should not be a consideration in my view. Of you trying to predict a recession and making a decision about whether to start. It is a factor in how you think about financing the business. It's a factor in how you think about growing the business and the decisions that you make. But if that is enough to sort of stop you, I think it's silly, because it's all predicated on the premise that you have knowledge about whether a recession is coming in the near term, which I think fundamentally is flawed. So I would definitely encourage anybody who's excited about starting a business and feels like they have something to market. The other thing to note, we're talking about venture backable businesses, I think, for the purpose of this conversation at least. So usually there's not a massive window for when your company is most relevant. Usually with a lot of venture-backed businesses, there's some macro feature that happened that enabled the creation or enabled a lane for you to create a lot of value very quickly. And so if you're going to say, I'm going to wait a year or two to start this, that ship will probably have sailed in most cases.
Yeah, when we ask why now is never a function of the market. So I totally agree with Austin. And there's macro factors that could potentially play into recession that often are great times to start businesses. Look at the education market. There's 1.6 trillion in federal loans. There was 1.4 2 years ago. Regardless of a recession, great companies can be started in any market.
Yeah.
I totally agree. 100% agree with Austin and about the market fit. But what I want to add is that the most brilliant ideas, if you're constrained because of the recession, you don't want to start a company, actually came out from recession. If you look at the history, companies like IBM, General Motors, Disney, Burger King, Microsoft, CNN, all these great businesses founded and started during the recession in the past, probably 30, 50, 40, 50 years ago.
I have nothing else to add, but if you have self-doubt, you should just go watch some of the Gary V videos to get pumped up. Honestly, like if you're thinking about whether to start or not and you're basing it on the recession, you have self-doubt. So you should figure out how you can get over your self-doubt before you go build anything.
Yeah, I agree with everyone here. I mean, look, startups' biggest advantage over other companies is their speed and agility and time to market. So, I mean, getting out there and moving fast is absolutely crucial. So, waiting to start a company, Austin hit the nail on the head, is the exact opposite advice I'd give. I'd say get out there and test and try to get to product market fit as soon as you can.
Awesome. All right. Thanks, guys. Yeah, so I guess we've been spending a little bit of time talking about how and what happens to a startup during recession, and I want to switch the tables a little bit. So I guess describe what it typically happens to a venture fund during a recession. Should investors be fearful, or is it really an opportunity? So I guess, yeah, what goes bad, what goes good during a recession, and how should they prepare?
I'd assume that most of the people on this panel were not working at venture firms in recessions.
Right, but I'll add to that. I guess how would that impact a founder and how a founder speaks to an investor in that kind of environment?
No, absolutely. I wasn't saying that to be dismissive of the question. It was more that take any advice that most of us
with a grain of salt.
Salt, yeah. So I like going into a recession. I'll speak from the standpoint of a seed fund, right? Like a lot of what we do is, post investment, we want to ensure that we are able, we can back you in your pre-seed round, your seed round. We're going to look to somebody else to lead your A round and beyond. So a lot of what I do is, trying to get people like Brett and excited about the companies that I'm invested in, and have them take that, have them look at the market and look at the opportunity, and then want to back that. So I'm usually not holding a board seat all the way up until they IPO or and certainly not like the lead investor of any later rounds. So when I think about how we sort of adjust, a lot of it is driven by what we think our later stage investors are going to do, and we do have to pay attention to how they think about the market and how they look at the market and go on. So Brett, what do you think?
Yeah, no, it's a fair point. I mean, I think it might help to step back and figure out what happens, when you hit a recession, right? So we raise money from our institutional investors, right? They allocate towards venture, and they usually allocate a small percentage of their overall portfolio to venture. It might be 2, 5, 10%, some small piece. That's not a liquid investment. It's very illiquid. So when the recession hits and public markets go down, now they're over allocated on a percentage point to venture, right? And now they stop funding our future funds, right? So it's harder for us to raise capital. It's harder for us to raise our next fund. Every venture manager knows this. So we know that we've got to make this fund maybe last a little longer, potentially. And so you start to see, less activity. And then every venture manager knows that. Every other venture manager knows that. So they might want to reserve a little bit more for follow-on capital. And this is what leads to, maybe less deals getting done, or maybe it taking longer for deals to get done in the venture community.
So what I can add is that, again, in general would be I agree with all the points, but to add on is that in general would be much harder to raise, money during recession, and especially from angel investors. And usually VCs probably take less risk and more cautious. And usually we might see even a smaller exits, and will offer lower valuation to get the same return of return, and which might cause a lot of flat or down rounds during the downtime. And by might be even LPs stop investing in the new funds, and would be much harder for VCs to raise money from LPs for the next round. And it's kind of chain of commands, which that are all related, and the companies with good financial and strong KPIs, I think they're going to continue to raise money. But for seed round, pre-seed, and early stage companies, probably is it's going to be they're going to get some software and much be harder to raise money.
Yeah, it also depends on who you are. Unfortunately, it shouldn't, but it does. It depends on if you have a brand name fund, if you're on fund 5 or 6 versus, a new fund 1, and where you're at in your fund life cycle. What are your recent wins? What's your IRR? What's MOIC? Right? All the metrics that LPs care about. It's just, it's harder to raise, but those funds that are in the top quartile or top decile are still going to get it done. I highly doubt any of the LPs who are in Sequoia are going to back out just because, there's a recession. So that's unfortunate. That's unfortunately the way this industry works, and which is why all of us are on panels like this to try to build up our brand and our credibility, and not be hit so hard when the recession comes from a fundraising perspective.
Yeah, no, that was a good segue, Matt, into the next question, which is, so let's say recession hit yesterday. Obviously, it takes time, right? To from LPs might start kind of allocating less towards venture, but until the time that all the funds need to go out and raise their next fund, it might take a while. And so it doesn't necessarily start impacting the founder on that day. But let's say you're a founder, the recession was yesterday, you're talking to VC funds about raising, that next round. Should it matter in that scenario who you're talking to? Like, should you care if you're talking to a brand new fund on their first fund or an established fund, or should it matter if they're talking to someone, to a fund that's 2 years into their fund versus 1 year into a fund, regardless of how many funds the VC fund has held? Like, do any of those things matter to an entrepreneur?
I mean, they should, right? One of my biggest gripes with taking pitches is that founders didn't do their diligence on me or us to know if we'd be a good fit for them. Because at the end of the day, the VCs, like, the difference between a successful and a not successful investor really comes down to time management. And it's a lesson I learned. It was a hard lesson to learn, but you've got to basically figure out where to spend your time. And any pitch that you take from a company that isn't aligned with your thesis or the stage of your fund, frankly, is time you can't get back, right? So you got to make sure the venture fund has some gunpowder, that they're actually investing. That's number one. And the reality is half of us on this panel weren't here if the funds weren't here a couple of years ago. So if you're not doing yourself any favor if you restrict it to only talking to established funds. Frankly, maybe I'm slightly biased, but the newer funds are the ones that have more to prove. They're the ones that are going to work harder for you. They're the ones that, haven't made the FU money and don't have a big house off Sand Hill Road, right? They're the ones that, are going to break their back for you as an entrepreneur. And we very much take that tact here. But, again, like, the onus is on you as a founder to do your due diligence on us. We put you through a diligence process, put us through a diligence process, talk to our founders, talk to other people in the community, ask questions so that, you can find the right investor who you actually want on your cap table.
Awesome. Thanks, Matt.
Somebody said Matt said ask questions, and I was actually about to encourage everybody to type questions into there, into the bottom, so we could see what people wanted to ask. I know you'll probably have a section for that, but
this is actually this was the final mandatory question. So I think we have about 15 minutes left, so we can start moving into questions. Someone asked if we could start moving the chat beyond the recession. I think the topic is recession, but if you do want to ask, questions that are semi-tangential or you really have a burning question that you want to ask this panel, feel free to type it in.
We could talk about the Lakers the whole time.
But yeah, I guess, feel free to ask away. I don't see any other questions beyond. Yeah.
Oh, the first question was theory in the sports space. Steve Bradbury, about like whether sports in the recession or challenging times. Yeah, I mean, people discretionary income, as I think Matt alluded to this earlier. I can't remember who did. Discretionary spending gets cut. Personal discretionary spending, anything that people are spending on gets cut. And so those are the consumer startups that do poorly. What hasn't historically gotten cut is things like cable bills, based on a recession, at least. Maybe that'll change in this new recession. But so sports seem to be fairly resilient. I mean, I don't have a especially insightful thesis about sports specifically, but I'd imagine that companies in that space or in that vertical will fare well, particularly like if they're not even tackling professional sports, but if you're looking at like high school sports or startups that I've seen around that area, things that people will continue to do from a consumer standpoint. I mean, you could look at historically how they've been impacted by recessions and figure whether or not it makes sense for how impacted it will be. But again, if it's a company that you're passionate about, I wouldn't care how the recession will impact it. I'll just leave it there.
So someone asked a question about, I guess, geography in a recession. Anyone have any thoughts about that? I mean, like, would you expect a place like San Francisco that has a much heavier concentration of tech to be hit harder than somewhere like LA or New York that's a little more diversified? Does not make a difference.
I think it's probably less geography and more the profile of the business. I think geography comes in a factor in terms of hiring. That's my take. I think a lot of the points that Brett made earlier in terms of the business are probably more important than the geographic location.
Yeah, and that's, I mean, a few people are asking about, space. So someone asked about sports, which we already talked about a little bit. Someone else asked about, kind of thoughts about real estate, and try to tie that a little bit back to the topic. So I guess what, in your mind, kind of what are some industries that you feel like would be the most recession prone versus, otherwise?
Marketing tech, ad tech, super recession prone. And thus, for that matter, a lot of media that's ad supported gets hit very hard. Ad budgets are usually one of the first things to get cut in really tight times. And so if you're on the media side on an ad supported model, you might either want to diversify to some sort of subscription, something that will help stabilize your cash flow, or not.
That's a good one. I'd add travel as well. It's a tough market to begin with, and probably gets a lot tougher in a recession as well.
Anything that's consumer that's a nice to have and is not a utility. A lot of the innovation in the real estate space, so there's even services sort of businesses for consumer companies. Anything real estate from the lens of like flipping homes, they kind of work on risk pooling.
Yeah, to my view is that because we have, as I mentioned, we have 300 corporate partners from 14 different industries, range from Daimler to ExxonMobil to JetBlue. And based on the conversation that we constantly, our teams have with these different industry leaders, I think if something happens like recession, a small recession or big recession, the immediate budget that these companies will cut is innovation. So that means in general, these companies will spend less money on innovation and try to maintain to see what is going to change in industry and how big that impact is going to, be on their industry. That's why I think that on tip of the iceberg, on top is just innovation as to me. That innovation budget will cut. If the innovation budget cuts, then that means they're going to have less engagement on acquiring the companies or talents or even piloting, working with the startups. And that means VCs like us might, spend less money because usually for our investment, we get feedback for every single investment from our corporate partners. So if that company is in mobility, we are going to just ask for feedback if this company is good or bad. If the recession happens, if there's no innovation and they just spend less time, then that means even from our side, should expect more cautious and less investments in general.
I guess the one thing we didn't really talk about much is the acquisition environment, right? So we touched a little bit on IPOs, and it's obviously an exit both for investors and for founders as well. But I guess for later stage companies, how should they think about acquisitions in a recessionary environment? And I guess for earlier stage companies, should that even be on their mind at the moment that a recession is happening?
Of all the panelists, I think Brett, I hate to throw it over to you, but you're the latest stage guy here. So.
Yeah, that's fair. Especially, seed, Series A, it's never really a consideration. We're not trying to do some sort of private equity roll-up model. After we've invested, maybe in the later stages, that starts to come up a little bit and conversations start to be had. But it's usually opportunistic at that point. I don't think it has so much to do with the recession as it does with, specific company that could augment a product and accelerate the product development and product roadmap in some meaningful way. So I think it's less about, I think it's stage specific, and I think it's less about the recession and more that it's a good strategic fit to make that acquisition.
Yeah, just to quickly add on that. We talked about the runway and how critical that is, and ensuring that burn is in line and in order. But I found that the recession's and I went through the recession as an operator. I find that it's a good time to refocus on your partnerships via channel or the reseller, or even if it's product integrations, third-party data set integrations, and product development initiatives. Instead of doing the slog door-to-door, all the direct selling, basically if you can establish more of a moat around the product while you kind of wait for things to correct themselves and for the budgets and the purchasing power to come back from the organizations you're selling into, then you're you're still operating the business, but you're just starting to shift your priorities based on the fact that, your sales cycle is going to be longer because, there's not as many buyers out there. That's my perspective from a SaaS and enterprise perspective, but I'm guessing the same holds true on the consumer side of the house as well.
All right, so I think we have about a little more than 5 minutes left, and a bunch of questions about things outside the recessionary topic. So if you have a question that doesn't really have to do with the topic of this hour, but you'd like to ask the panelists right now, feel free to add them. We have a couple questions, one from Scott and another one from I think Dalmatian about how to get on an investor's radar. One question was, do we look at cold emails? What should be included? Another person was asking, if you're a founder, in his case, in Riverside with deep tech solutions and patents, how do you get on the radar of funds? So again, not related to the recessions, but if anyone wants to take a stab at either of those.
Yeah, I'll do it quickly, kind of addressing both. I'll definitely look at cold emails. So long as I feel like the folks have kind of done research on us. So sometimes it's not even like just picking one company and saying, hey, I saw you invested in this, we're doing this. It's reading, the blog posts of, hey, where are we investing now? What do we care about? So if someone's able to create that narrative hook, I think that can go a long way. And those are the cold emails. I try to respond to everything that I can. But in terms of cold emails, that's probably going to get the highest hit rate. And then in terms of for those at the pre-stage, would you recommend trying to raise sooner than planned due to a possible recession? I'd say go out when you feel like you've got the product in place. When you feel like a set of institutional investors is willing to, support you throughout the journey. So it really depends more on, product and is it ready to go sort of thing. I think there's a misnomer here, pre-seed, and it may be because the goalposts have changed a little bit, but pre-seed doesn't mean, pitch and pre-product. I think it means like, hey, I've kind of got the product ready. Maybe I don't have customers. So I've had kind of varying conversations about what is pre-seed. I think pre-seed is sometimes considered synonymous with like angel investing from 5 to 10 years ago, which is really just kind of like backing people with an idea. So kind of know what the firm is looking for, when you're thinking about pre-seed, and usually you want some sort of MVP or product ready.
Can you answer that, Eric, since you invest pretty early?
Yeah, so I was going to say too, what we have today in the year 2019 versus what was available in 2009, so just 10 years ago, if you're a founder trying to get a sense for which funds you should be talking to, which people at which funds you should be talking to, there's just so much more information out there. One is, to John's point, every single, fund, us included, are putting out a lot of our own information around the sorts of companies we invest in, the progress of our companies. So, just without even talking, there's enough information just coming from, the funds themselves, but also, like you can very quickly go on Crunchbase and look at basically every single company that Amplify is invested in, and not just Amplify, Sway, TenOneTen, Fika, Plug and Play, and see where they're investing, right? Look at the most recent, 5 investments, and you'll get a sense for what stage they're at, what sort of industries, are they all kind of B2B? Are they all over the place? Is it all very, very, very early? Is it, right? So that sort of stuff. And especially if you don't, and then I think based on that, kind of tune your list of which funds you want to be talking to. And from that moment on, any let's say you're talking to Austin and you really want to talk to Amplify, or you really want to talk to Fika, you can probably assume that if there's a fund on your hit list that's in the same city that Austin is, or that I'm in, that you thought was like one that you really want to talk to, just proactively just be like, hey, by the way, do you know anyone at X fund? I noticed that they're very, very, it makes sense for me to be talking to them. Would you mind making an intro? And 9 times out of 10, presumably, Austin would want to make that intro. So I think the hardest thing is getting that first meeting with that first VC or that first person that's going to introduce you to the space. But once you're in, if you've done your homework, you should be able to try to get some of those warm intros to everyone else in the space.
Yeah, what both John and Eric have basically said is you've given us a reason to answer that email, right? That compels us to want. Well, I'll tell you what doesn't work is, when you're on a, templatized email that you can tell that got sent out to, 100 different investors, and there's nothing personalized about it. Those probably have a low chance of success. Or if the other thing I'll tell you that probably doesn't work either is if you email me and then you also email like 5 or 6 other partners at Sway, and we all get the same email. That again just feels like a buckshot approach and just doesn't work very well. You should have a reason why you're reaching out to that person specifically, and why they would be interested.
There is a good list of venture funds that's put together by Upfront. I'll post it in the comments. So if you're looking to try to find out where do I start, highly recommend you check that out first. I don't think getting covered. I think it may just be LA, maybe some Bay Area stuff too. But happy to share that.
All right. Any final closing thoughts by anyone? I think we have 60 seconds left.
Thank you all for having us.
Thank you, guys.
Cool. All right, thanks guys. Back to Lucas and thanks again to Lucas for organizing such a great event.
Far too kind. Thank you guys so much for being on the panel. Super insightful. I know sometimes that it's not as relevant for some of the startup founders just thinking through and trying to get to that next round, but different considerations on the mindset of the VCs. So I appreciate that very much. We will be back in literally a minute. I got Sean Cheek coming up next to talk about growth hacking. Thanks, guys.